Today, we are talking about dividend investing. Dividend investing is what draws a lot of investors to the stock market. It was really the main way of investing for a lot of people, like my grandfather and in that older generation. But not a lot of people focus on dividend investing now when they're building a portfolio because there's just so many more high risk but high reward stocks and a lot more spec stocks that are out there with technology really taking over within the past 10 to 20 years. So in this video, we're going to go over the do's and don'ts of how to invest in dividends. What are some things that I look for? And ultimately, what I think people are doing wrong when it comes to dividend investing. Now, I don't want to say that dividends are bad and that I wouldn't have a dividend portfolio. I would just say that it is not as popular as it was once before. I currently do not have a dividend portfolio, and that is simply because I don't believe a lot of stocks are undervalued at this very moment. However, if we see a correction or a potential another market crash or pullback within the next couple of years, I do plan to deploy some capital and build a long-term investment portfolio that is based around dividends. Let's get into it and let's start talking about some things that I would be looking for when it comes to building a dividend portfolio. And really, most importantly, what are some things that people do wrong? So I put this list out here. And what is a dividend? This is the most important thing because I don't know if some of you guys know what dividends are, but a dividend is a percentage of profits that a company gives back to its shareholders in return for being a shareholder. So when you buy a stock, obviously that money goes into the stock or into the company. You own a percentage of that company. That company has that money in which they will go ahead and reinvest it into research and development, potentially, going towards payroll. All of this is on a smaller scale, but obviously with a company like Tesla or Apple, it is on a massive, massive, massive scale. And your return that you basically get for risking your money by giving it to that company and owning a percentage of that company is that one day the stock will appreciate in value and you can sell those shares to somebody for a higher price. What some companies do is they give a dividend. They will take a piece of the profit that they made that quarter and they will actually give it back to the shareholders of the company as an incentive to continue to hold on and or hopefully buy more shares of the company. The biggest thing that you have to realize is that a company has to be profitable in order to issue a dividend. Now, what you will realize is if you're a newer investor within the past couple of years is that a lot of your favorite companies, such as maybe a Tesla, do not offer dividends. Something like Tesla, something like Amazon, these big tech growth companies usually don't offer dividends because they take all of the money that the company makes and reinvest it. And from a long-term investing standpoint, I agree with that. That's why I'm not a huge fan of dividends, and it's not like a make or break for me when it comes to investing, is because I would personally rather the company put the money back into itself to build the company to become bigger so that the company actually appreciates in value and I can sell my shares for a higher price later on. What drives people to dividend investing is the fact of consistent income month after month, quarter after quarter, year over year, no matter what the stock is doing. So now let's get into the actual do's and don'ts. So the first thing is do not focus on just the dividend return. Do focus on the quality of the company that you are investing in. This is something that I notice a lot of people do wrong, and it's that they focus on the dividend itself as opposed to the company. So right now, this is NerdWallet. This is an article where they go over the top 25 highest paying dividend stocks that are out there right now. What I want you to do when you find a company that has a dividend that you like, I want you to first make sure it's a company that you want to invest in. Who cares what the dividend is? What you need to focus on the quality of the company that you are buying, because at the end of the day, how that company appreciates or depreciates within the time that you're holding that stock is much more important than just the dividend. So if we look at NPK, which is National Presco Industries, they have a dividend of 7.48%, which is very, very high. So if we look at a chart of NPK, which we're not focusing on like technicals or anything here, which we talk about when it comes to investing long term. When it comes to trading, we're just looking at how the stock has performed. So I'm looking at a monthly candlestick chart of this, which means each one of these little candlesticks represents 1 month. What you can see here with something like MPK, let's just do a weekly. Actually, it'll be a little bit easier because I don't need to look at 20 years. What you'll notice is right now, NPK is trading at $82.42 per share. And if we go all the way back to January of 2011, so 10 years ago, this was trading at $87. So if you were have bought NPK 10 years ago, the stock would have basically, you would have lost money on the appreciation value because you would have ended up buying it, like we said, around 87, and right now it's trading at 82. So you would have actually lost 5% on your shares. But because it has a 7% dividend, and dividends do tend to increase, you would have still made 70% return on your money because you're getting 7% per year over a 10-year period. So this is not that bad of an example because even though you didn't make money on the shares, you still made money on the dividend. Another one, for instance, is Onoki. Oneok is the second one. I've actually never heard of this company, but the ticker is OKE. If we take a look at this as well, and we look at what the price of the stock is right now, it's $52.40. If you would have bought this 10 years ago, you would have made a very small gain of about 34%. Now, 34% is not bad, but for holding this stock for 10 years, it's really not the best. And that's if you didn't sell it when it bottomed out down here at 1843. So a 32% gain plus that 7% dividend is very, very good. If we take a look at something like Chevron, which is CVX, which is the next one, let's take a look here. You can see that with Chevron, if you would have went and bought this thing back in 2011, you would have actually ended up losing money. If you would have bought it at this time in 2011, 10 years ago, you would have entered it at $110 and you would actually be down 12%. But remember, it has a 5% dividend, so you would have made 50% return on your money minus that 12%. So what I'm trying to explain here is even though most of these companies have actually not underperformed over the 10 years, they mostly have just gone up a little bit, gone down a little bit, or sat sideways. It's important to look at the company over the dividend. Now let's look at a company that I would recommend, and I am going to do a full video on how I would build a dividend portfolio and certain portfolios. Let's look at a company like Skyworks Solutions. Skyworks Solutions is a company that offers a small dividend of about 2.5 to 3%. I haven't looked at it in a bit, but it's not a massive dividend. However, if we look at this company, if you would have bought this company back in 2011, which is 10 years ago, you would have made 1,000% return on your money, and you would have made a 30% dividend. So what I'm trying to explain here is that the quality of the company that you're investing in is much more important than the high dividend that you're going to get. There are a lot of ETFs out there that will give you a massive dividend, 12, 13, 14%, but the basket of stocks that it is holding are usually garbage. Some dividend ETFs that I really like is SPHD. This is a good one as well that I really like. And also QILD is another one. But I will go over those and some of my favorite dividend stocks when I actually do a dividend video of building a portfolio. This video is just do's and don'ts, but I will do a video on how to actually build a portfolio within the coming weeks. So the second thing is do not be short-sighted when building a dividend portfolio. A true dividend portfolio should be built for the next 10 years minimum and should focus on compounding dividends and reinvesting them or having a drip. I've made videos on this channel before about a drip, but going back to what I was saying earlier, you don't want to be short-sighted. You don't want to look at how big is the dividend, how much money am I going to make off of the dividend. You want to focus on the quality of the company, how it's going to perform over the long run. And with a dividend portfolio and building a dividend portfolio, the real reason I don't really have one at this point is that you're not going to be entering positions that you plan to hold for a year or 2 years. There are, in my long-term portfolio, I have companies that I'm buying that are spec companies, but I only plan to hold it for 2 or 3 years. To me, that's a long-term investment because I'm a full-time trader. I would rather deploy that capital into trading stocks or maybe buying real estate over long-term investing when I feel like not a lot of stocks are at a fair value. So when you're building a dividend portfolio, don't look at like, oh, I'll hold this for a year or 2 years. A dividend portfolio is usually a portfolio that you can fully retire off of. So these are companies that you're going to plan to hold for 10, 15, 20 years. PPC Ian is a YouTube channel. I highly recommend go and check out that guy. He is a full-on dividend professional. I don't know if I said it earlier, but definitely go and check that guy out. But these are some of the things that I look for. Is I want to make sure that it's a company I'm okay with holding for the next 10 years. Let's take a look at the third one. Oh, actually, and a DRIP. So a DRIP is a dividend reinvestment plan. So what you're going to want to do is take all the money that you make from those dividends and either start a DRIP, which some brokers will automatically reinvest those dividends into partial shares so you can continue to buy the stock in dollar cost average. Or if you have a broker like Robinhood, which is in the title of this video, you can actually just go ahead and when you get that money deposited into your account, go ahead and buy more shares. I highly recommend just continuing to reinvest all the dividend money that you get. Now, third thing, do not load up on the same sector or the same region. Diversify across countries, regions, and different sectors. So, for instance, let's say that you have 5 companies in your dividend portfolio and they're all Chinese companies. They might be different types of companies, like you might have an Alibaba, or you might have like I don't think EDU or TAL pay dividends, but let's just say they did, an online education software company. Even though those are 2 different sectors, one is like e-com and one is e-learning, what you have to realize is that if you're in the same region, if something happens like the Chinese Communist Party, which is a CCP, does something crazy, like for instance, a couple of months ago, TAL crapped the bed, which was a company I was invested in long term. I really like the company, but the Chinese Communist Party decided to say that they are going to try to make all of these online education software companies no longer businesses, but actually nonprofits, which obviously kills the company. So you have to realize that not only should you invest in different sectors, but different countries. Another thing would be if you had like a Wynn Resorts. Wynn Resorts, that is a travel company. However, their main, bread and butter casino is in Macau, which is in China. So let's say that something happens in China, like a massive natural disaster that wipes out a quarter of China, which God forbid that never happened. But if that did happen, it could really mess things up because you have 3 or 4 companies that are all based within the same region. So definitely think about that when you're building a portfolio. So I said, as well as natural disasters happen. Now, a lot of people might be saying, I thought you said diversification is for idiots. I have said that before. Warren Buffett says that. Mark Cuban says that. Why is this different? So when I'm building a long-term portfolio, I'm really only planning to have 3 companies in it. The reason that I say this is because when you're investing in a company and you have a hunch or an edge on a company, I believe you shouldn't have more than 3, 5 max, because you cannot truly know the ins and outs of every part of that company if you have 20 of them, 30 of them, 40 of them. That's a full-time job. But I can manage and track 3. However, if I'm building a dividend portfolio, I want to have about 10, maybe minimum 5, but really 10 different companies, and I want to diversify because, like I said before, we are holding for the long term. We are holding for the next 10, 20, 30, 40, 50 years. So if something bad happens in one sector, I want the other sector to catch up for it. So like I said, I am going to actually do like a dummy portfolio. I'm going to build a dividend portfolio for you guys if you want me to. Make sure to comment down below if you want me to. But I wanted to make this video in hopes to help you guys with understanding some good and some bad things with dividends and how to look for, the main staples and stay away from bad choices when it comes to dividends. Because the biggest thing is a lot of people focus on how high of a return you're going to get on the dividend, but they don't truly focus on the quality of the company that you're buying. Guys, I hope this video helps. Hit the like button, subscribe to this channel, and thank you for all the support. Hit the notification bell so you can stay up to date with all of our videos. Check out our second channel, Traders Helping Traders, our free Discord, which is going to be in the description below, and I'll see you guys next time. Peace.